Hi everybody. I can't believe I'm competing with 70-degree weather. It's so beautiful outside. I thought I would not even come here myself. I almost sat down on a bench out there and enjoyed the weather. But instead, you folks have decided to come to an income tax seminar. Isn't that fabulous? All right, so what Monica was saying is that the tax code in the United States is the most difficult in the entire world. I know because I've counted, and there's 4 million words in the Internal Revenue Code, and it changes all the time. And today we're going to be talking about the taxation of G4 visa holders, as well as the taxation of their spouses, the G4 dependent spouses. Now, the Wolf Group is a CPA firm. I'm the International Tax Director there at the Wolf Group. And we've been helping international organization employees now for about 30 years. So I think we'll be able to have a very enjoyable session here today. But instead of answering questions at random, I would like to save them to the middle and to the end. And I'll let you know when the middle and when the end is so you can ask your questions. And this is being videotaped. So that everybody can hear, I'm not sure, since I think the question and answer period is going to be edited out, perhaps, so that I may not require you to go to the microphone, but instead, during the question and answer period, you can talk from your seats because it would be very difficult for most of you in the middle here to get out to ask questions. So let's get started. What are we going to talk about today? We are going to talk about the general basic income tax residency rules that apply to G4 visa holders. We're then going to talk about the taxation of non-residents of the United States in general and how it specifically applies to G4 visa holders and G4 dependents. Finally, we'll talk about some tax return issues and real estate matters, which is really important, especially for non-residents and G4 visa holders. And some other important issues I'll save to the end. So what this disclaimer says is that it's really hard to just give general rules and for you to go back and do your tax returns based on those general rules. Because as I said, the Internal Revenue Code has over 4 million words, and there's generally the general rule, the exception to the rule, and the exception to the exception. So I can't go over every possible aspect of those today. So hopefully you'll get enough out of this to realize how complex it is. And many of you may have very simple tax situations, so you actually may be able to file or not file your tax return based on what you hear today. But I always advise to seek professional help. It doesn't have to be from the Wolf Group. There are many tax preparers in the region that understand G4 visa holders, but they have to understand G4 visa holders if they're a tax preparer, because otherwise you're likely to get wrong advice or bad tax work. So, U.S. tax residency. This is a very important concept that you all should know about. U.S. tax residency means if you become a U.S. tax resident, you'll be subject to tax in the United States on your worldwide income, no matter where it is derived. You say, well, Dale, what if I derive it in the U.K.? Yes, you would still be subject, if you become a U.S. tax resident, to income that you earn in the UK or anywhere else in the world. Well, what if it's taxed in that foreign country? Surely the U.S. government doesn't require that I report on my U.S. income tax return the income that I earn abroad that's taxed in that foreign country. Well, guess what? Yes, they do. No matter where you derive the income, it will always be reportable on your U.S. income tax return if you become a tax resident of the United States. The tax relief that you get if you were to pay tax abroad and you're a U.S. tax resident is you get what's called a foreign tax credit. A foreign tax credit, so you won't end up paying double tax when you become, or if you become a U.S. tax resident. You won't end up paying double tax. Instead, you'll pay the higher of the two tax rates. The higher of the foreign country tax rate on that income or the U.S. tax rate. And a calculation is done within the tax return that alleviates double taxation for U.S. persons who are subject to tax on their worldwide income. So the good news about non-residents, and many of you will find out in a second that you're most likely non-residents here, non-residents are not subject to tax on a worldwide basis. Instead, non-residents are subject to tax in the U.S. on certain limited sources of U.S. source income. So foreign source income is not taxable by non-residents. Instead, only U.S. source income is taxable by those non-residents, to those non-residents. And I'll go over what types of income in a moment that's taxable to non-residents. If you decide to become a green card holder or a U.S. citizen, you will be defined as being subject to tax on a worldwide basis. You will be a tax resident at that point. If you are a U.S. citizen, we have many clients who were born here, and simply being born in the United States automatically makes one a U.S. citizen, and therefore those babies that are born here by a foreign national coming in, born here, many of you have U.S. kids, if you were to take them back to your home country, they will always be considered U.S. tax residents, always having to file U.S. income tax returns. So when they're going through puberty and talking to them about certain issues, you definitely have to talk to them about U.S. taxation. That you yourself may not be a U.S. citizen, not subject to tax on the worldwide income, but your kids who are born here will be. And so they have until 18 and a half years old to give up their citizenship in order to avoid what's called the exit tax. Because you can't simply get away from the U.S. government by simply giving up your citizenship. There's an exit tax that may apply. So make sure that you talk to your kids if they're U.S. citizens. Now the final way that you can become a resident, besides being a U.S. citizen and a green card holder, is if you meet the substantial presence test of residency. Now, many of you, unless you're very close to retirement, won't be getting a green card anytime soon, but just know that your first day of tax residency as a green card holder will be the first day that you're located in the United States with a valid green card. So any of you here applying for a green card, know that as soon as you get that green card, a valid green card, you become a tax resident at that point if you're in the United States. Now, what is the other way besides being a citizen, being a green card holder? What's another way of becoming a U.S. tax resident? And that would be something called the substantial presence test of residency. It's based on just physical presence in the United States. And what you'll find out in a moment is that G4s who work on a full-time basis with an international organization are excluded from counting days under the substantial presence test. But you may have relatives, maybe grandparents from abroad that want to come visit their grandkids on a regular basis in the U.S. They may run afoul of the substantial presence test of residency. It's a test based on physical presence days for any foreign national coming into the United States, and the magic number in which they trip the substantial presence test is 183 days. But it's not based on just 183 days in the current year. There's a formula, of course. The formula is you take the total number of days that foreign national is in the United States during the current year. You add to that 1/3 of the days that they were in the U.S. the year before that, and 1/6 of the days of presence for that foreign national in the U.S. the year before that. And then you add them up, and if it turns out that if it's 183 days or more, when you do the formula, then they generally become a tax resident of the U.S. in that year. So just tell grandma and grandpa that that based on this rule, they have to watch out for their number of days in the U.S. And it doesn't matter what type of visa that they come in under. So if they come in under a tourist visa or what have you, this test will still apply. And once they get to the 183-day mark, this is the general rule for tax residency. Just tell them, Grandma, I'm sorry, but you were here too long in the U.S., and now you have to file a tax return in order to avoid paying tax on a full worldwide basis. Or you may have to file tax returns to the U.S. on a full worldwide basis. So next time, bring Grandma to the presentation. Okay, so I just talked about foreign nationals, and almost everybody here, unless some U.S. people snuck in, is a foreign national. And those foreign nationals that are here, we're wondering, uh-oh, am I tripping the substantial presence test of residency? And the answer is generally not. The reason that you, G4 visa holders, are non-residents of the United States is not because you hold a G4 visa. There's nothing in the Internal Revenue Code at all that talks about G4 visas. Instead, it says that if you are a full-time employee of an international organization, your days don't count. You're considered an exempt individual for purposes of this day counting number under the substantial presence test. So your days don't count. It's like you're not even here. If you are, you're invisible. I can't see most anybody here. The good thing is the IRS can't see anybody. It's like you're not even here, so you don't trip the substantial presence test of residency, and therefore you are continue to be a non-resident. Now, what I do want to mention is that how many people here are G4 spouses? Congratulations for being a G4 spouse, because your residency status, you know, your spouse that works on a full-time basis at an international organization is exempt. So the World Bank employee is exempt, an exempt individual, so your days don't count. But the good news is the tax law says the G4 dependent spouse takes on the same tax residency status as their World Bank employee spouse. So if you're a G4 dependent and your spouse is working at the World Bank on a full-time basis, you are also invisible. So you are exempt from the day count under the substantial presence test, so the G4 spouses are also non-residents of the U.S. That is why you're non-residents. All right, so there are two ways in which non-residents of the U.S. can be taxed. But before I talk about the ways that non-residents are taxed, let me talk about the ways that you're not taxed. So we talked about the reason why you are non-residents of the U.S. And by the way, your kids who are under 21 and not married, and if their visa status is dependent on the G4 primary visa, then those G4 dependents are also non-residents of the U.S. They take on the same residency status as the primary G4. So unfortunately, I'm going to have to wait until we have the questions, probably another 10 minutes or so, then I'll be glad to take the questions. So there's the G4 primary visa holder who works for the World Bank, or by the way, the IMF or any international organization, the primary G4 visa holder, the wages that they receive are completely exempt from taxation because of a special rule in the Internal Revenue Code that talks about wages of international organization employees are completely tax exempt. So most of you whose spouses are the primary G4 working for the World Bank, those wages are exempt and they're non-resident. You can't almost get any better than that. So, now other people who don't work for international organizations, such as the G4 dependents, have a way that they are taxed in the U.S. And that way, the technical term is, if you're working as a G4 dependent visa holder and you're working for other than an international organization, if you're working here in the U.S., you have what's called effectively connected income. Effectively connected income. And that income is effectively connected with a U.S. trade or business in the U.S. In other words, you're taxable. Even though you're a non-resident, because your work's derived in the United States, those wages or self-employment income is taxable by the G4 spouse. And if the G4 primary visa holder has a side job, which I know they're not supposed to have, but let's say they might have a rental property in the U.S., that also, a U.S. rental property is also considered, in most cases, effectively connected income with a U.S. trade or business, so it's taxable to the G4 or the G4 spouse. Now typically, effectively connected income can be offset with certain types of tax deductions, but very limited type of tax deductions, which we'll go into in a moment. The other type of income that you can be subject to tax to as a G4 or G4 dependent, a non-resident, is income that is not effectively connected with a U.S. trade or business, and that income is generally investment income. So if you're a non-resident and you earn certain sources of U.S. source investment income, you can be subject to a flat tax rate of 30% on that investment income. And we'll go over the types of investment income that you're taxable on in a moment. So many of you here know what I'm talking about when I talk about the W8BEN. The W8BEN. Whenever you sign up for an account at any U.S. financial institution, they will ask you to fill out one of two forms. The first form is the W8BEN, which is for non-residents, almost everybody here. The other form that they may give you is a W9 form. The W9 form, when you sign up with a financial institution in the U.S., is for only U.S. people who are tax residents of the U.S., almost none of you here. So just know that it's important that you fill out the right form when you first sign up at the credit union or a bank or any financial institution. Could be TD Ameritrade, Schwab, any financial institution. It's important that they have the right form on file, and that would be, again, for most of you here that are non-resident, the W8BEN. Why that is important is they will then know the type of tax withholding to do on your investment income, and they will know that your interest income that you earn from a credit union or a bank is completely tax exempt. But if you've given them the wrong form indicating that you're a U.S. person, they'll think that you're taxable on certain things, and then they'll report that to the U.S. So it's important you make sure that that is done correctly. Okay, so the good news that the United States government is going broke is that, and we've been going broke for a while now, is that we need as much cash as we can get into the U.S. financial institutions. To help that along, non-residents, including yourself and people that actually live outside the United States, are completely tax exempt if they have investments in the U.S. that generate bank deposit income or invest in U.S. Treasury bonds specifically. So interest income derived by non-residents that earn income from financial institutions, banks, interest income from banks or credit unions or Treasury bonds or even U.S. corporate bonds is completely tax exempt to a non-resident. Now it's taxable to residents or U.S. citizens, so another tax break for you. Now many of you will have received in the mail a Form 1042-S that would indicate if you completed the W8BEN correctly and provided that to the financial institution, you may have gotten this 1042-S form that indicates that you received certain amount of interest income during the year. Now this 1042-S form is given out by financial institutions to non-residents only. And how do they know you're a non-resident? Because you filled out that W8BEN. And because you did that, they know that the interest income that you generated is tax exempt. So the 1042-S form, if you received one, will indicate in the little box that the interest that you're receiving is tax exempt. So don't get panicked if you receive this tax form. It doesn't mean that you have a U.S. tax filing requirement. All that it means is the financial institution knows that you're a non-resident and they have to report this information on how much interest that you earned on this Form 1042-S. Okay, the others, now this is probably the mostly I find in practice, the the tax on U.S. source dividends is what we find most often with non-residents. They invest in any type of U.S. securities, a U.S. stock, and that dividend from a U.S. stock is considered U.S. source income. And so that income that you earn from dividends is subject to a 30% flat tax rate by the U.S. government. Now the good news is that if you would have given the financial institution a W-8BEN, they would know you're a non-resident, and any dividends that they provide you, or the company, the stock provides you with, is subject to a 30% withholding tax, the exact amount of tax that's due. So if you have given them the proper W-8BEN form, most of the time the proper income tax withholding will have been done, and then you don't have to file an income tax return. But if you gave them a W-9 or you let your W-8BEN expire, which expires, by the way, after 3 years, and many of you get it in the mail, a new one, and you say, oh, it's junk mail, and you throw it away, and then what happens is the U.S. financial institution has to treat you as a U.S. person, and then they give you the wrong form, and they don't do the proper withholding. So, again, important to fill out the W-8BEN. Okay, so let's go this one last thing, and then we'll open it up for questions for about 10 minutes. A very strange rule when it comes to non-residents occurs for only G4 visa holders and F1 visa holders. Now, F1 visa holders are students, and they don't earn very much capital gains from securities. This rule is that not only do you have to pay tax on dividends you receive from U.S. stocks, and by the way, if you invest in foreign stocks, even if it's through a U.S. broker, that's foreign source dividends to a non-resident, and that's not taxable at all. So what should you do to tell your broker, if I invest in foreign stocks, I'm not taxed on any of the dividends. But if I invest in U.S. stocks like Apple or IBM or what have you, I'm taxed at a 30% rate on my dividends. So just talk to your broker if you have one about that. Oh, so this other rule, though, with regard to capital gains, is a very strange rule, because the general rule is that non-residents are not subject to tax on the sale of securities if they realize a capital gain from either stocks, bonds, or mutual funds. That's the general rule for real non-residents. Those non-residents that I call real non-residents who are living outside the country. So if you were living outside the country and you had a stock, bond, or mutual fund that you sold at a gain, even if it was with a U.S. broker, there would be absolutely no tax. But this particular rule is for people who actually work and live in the United States but remain non-residents, such as yourself. And this rule is that if you sell stocks, bonds, mutual funds anywhere in the world, either through a U.S. broker or a foreign broker, you are subject to tax at a 30% rate on capital gains from the sale of those securities, and you have to self-report that on a Form 1040 non-resident income tax return, 1040-NR, and pay 30% tax on the gain to the U.S. government, and that would include people who have foreign brokerage accounts that they generate the capital gain and they have to pay foreign tax on that. Unfortunately, the tax treaties don't ever know what to do with a non-resident everywhere. In other words, non-resident in the foreign country and non-resident here, and so you're not allowed a foreign tax credit, which I mentioned earlier, on this particular item of tax. 30% capital gains tax from the sale of securities. So again, if you have a foreign brokerage account and you buy stocks and bonds, etc., you incur a capital gain, then you have to report that capital gain and subject yourself to a 30% tax rate. And unfortunately, there's no offsetting foreign tax credit. You'll pay double tax.
What's the form number?
The only time that you'll get a foreign tax credit is if you were to become a resident of one of the two countries. So in that terrible situation where you're doubly taxed, I think really the only thing you can do is move, if you're gonna be here in the US for a long period of time, is move that foreign brokerage account, move that money to the US so you don't get taxed abroad on those capital gains. And again, that tax return is called a 1040 non-resident tax return, a 1040 NR. So if you have a US rental property, you need to know that you could be subject to tax at a 30% flat rate, just like your investment income, if you don't make a special election. And it's called the net election. So in order to be able to deduct all the expenses related to your rental property, US rental property, remember, non-residents are only subject to tax on certain US types of income, and US rental property would be that type of income. If you have a foreign rental or a foreign sale of real estate and you're a non-resident, the US cannot tax that foreign rental or foreign sale of that foreign rental property. So just know that there's a special election. Again, the IRS doesn't make it easy because there's nothing on the tax form, which is a Schedule E for US rental properties. Again, if you're generating income from a US rental property, you would have to complete Schedule E, and that would go with your 1040 non-resident return. And you say, well, Dale, my husband and I have a rental property and we own the property jointly. Surely we don't have to file two separate tax returns to report the one rental income. Yes, you do. You have to file it, and you have to, because a non-resident return can't be filed jointly. A non-resident return has to be filed separately. So each non-resident has to file their own separate non-resident return. So if you have a rental property owned jointly, each of the couples has to report half of the income and half of the expenses on their Schedule E on their Form 1040 NRs, including half of the depreciation. You can't just elect to file the tax return and report the rental income on just one of the spouse's tax return. That's not allowed. You have to separate it. And you say, well, Dale, I've been doing it for 20 years. Well, you've got really lucky because you haven't been audited. And the only way that you know whether you've done something really correctly or incorrectly is most of the time you have to wait until you get an audit from the Internal Revenue Service. And then at that point, interest and penalties can be assessed. So it doesn't mean that you simply, there's some countries where you file the tax return and they look at it and then they stamp, we agree, and then you say, I'm fine. In the US, it's a self-assessment system, and you do your own calculations, you submit it, and if you don't get audited and 3 years has gone by, then you're safe. So the statute of limitations is 3 years for people that have filed US income tax returns. So if you're concerned about something that happened prior to 3 years ago, and you've already filed tax returns for the last 3 years, you can rest at night. You'll be fine because the IRS cannot audit any tax returns prior to 3 years ago, 3 tax return years ago. Okay, so the other thing is that, which applies to now everybody here, I would assume, or let's just say most people, is the sale of a principal residence. So if you own a home here in the US and you're a non-resident, there's a special, or even if you're a resident, there's a special exclusion of up to $250,000 per person, exclusion of the gain from the sale of your principal residence, the property that you're living in. So if you are single and you've lived in the property at least 2 years out of the last 5 before the sale, then you can exclude up to $250,000. And if you have a spouse and he or she is living in that property too, they can also exclude up to $250,000. So you can exclude up to $500,000 of any gain related to the sale of a principal residence. And that's a big deal. And that's probably why we had a housing bubble many years ago, and they still haven't changed the rules. So you just have to have lived in the property 2 out of the last 5 years. And why do I say out of the last 5? Because you could, and many people do, they live in their homes and then they say, oh, what we'll do is we'll simply leave the property, buy another property, and then we'll rent it out. But just know that if, in order to meet this rule, if you rent out the property, you can't rent the property out for more than 3 years. If you rent out the property for 3 years and 1 day, you won't meet the 2 out of the last 5 years test of having lived in the property. So then the whole $500,000 exclusion is wasted, and then you may have to pay a substantial amount if you were ever to sell that property again. But most of you will simply live in the property and then sell it. Just know that most of you won't have to pay any tax, and this would be for federal purposes, and Virginia, DC, and Maryland also follow the rules, so you won't owe any tax. Very important to know this. It's an acronym called FIRPTA, the Foreign Investment in Real Property Tax Act. And this requires, because the U.S. government, they don't really trust non-residents. They don't trust U.S. people either, but they especially don't trust non-residents because most of non-residents live outside the U.S. And if non-residents were to invest in real property in the U.S., how will the U.S. government get their money if the non-resident was to sell the property at a huge gain and take the money out of the U.S.? It would be very hard. So even though we talked about the fact that many of you will be eligible for the exclusion of gain from the sale of a principal residence, if you were to sell that principal residence, there's going to be a withholding tax. It's not a final tax, because we just mentioned that most of you won't have to pay any tax, but it's a withholding tax. So at the settlement table, there'll be a 10% withholding tax from the sale of any U.S. property, and that would be a rental property or even a principal residence. It'll be a withholding tax. Again, it's not a final tax. And the settlement agent at the settlement table will say, oh, you are a non-resident, you're selling your property, and so we have to take 10% of the gross sales price and hold that back. And what you'll find out in a moment is the settlement agent will either turn that over to the Internal Revenue Service, that full 10% withholding, or they will hold it and wait for an IRS letter, which we'll talk about. Now there are exemptions from FIRPTA, but really the only exemption is if you sell your property for more than $300,000, less than $300,000, then there is no income tax withholding on the sale of a U.S. property by a non-resident if you were to sell it for less than $300,000. So you say, Dale, so if I sell the property, whether it's a rental or a principal residence, they're going to take 10%. So if you sell a $1 million property, the withholding agent is going to take $100,000, 10% of the $1 million, and they're going to turn it over to the IRS. That's the general rule. They turn over that withholding to the IRS, and the only way you can get it back, because we mentioned the fact that if you're selling your principal residence, you don't actually owe any tax. The only way the general rule is the way to get it back is to file an income tax return. But here we are in February, even though it seems like it's June outside. We're here in February, and the general rule is that you can get your withholding tax back by filing an income tax return. But you wouldn't be able to file an income tax return for 2017 until 2018, till the tax forms come out. So if you sell your property now and they take in my example, 10%, $100,000 of the sale of a $1 million property, and they turn it over to the IRS, you'll have to wait an entire year to get your $100,000 back. And maybe you want to be able to use those funds, including to buy another residence or something. You won't be able to get your money back for an entire year. And if the IRS has your money, well, we know that if we have the IRS's money, we know that there's an interest and penalties that are applied. Do you think that the IRS pays any money on the money under this withholding that they have for you, that they could have for an entire year? Just by my face, you know that they don't pay any interest, right? So they could hold the 100,000 for the entire year and pay you nothing. But so they've left one out. Besides filing a tax return to get your withholding tax back, you can file this form called an 8288B. Now it's a little bit more complex and it requires much more paperwork, but you can get your withholding tax back faster, especially if you sell the property at the beginning portion of the year, like February, like right now. You can try to get your money back faster by filing this 8288B. What it does is, it tells the withholding agent, wait, withholding agent, you just withheld 10% of the gross sales price, hold it in a trust fund while we wait to get word from the IRS that it's okay to release that 100,000. The 8288B form, you show the IRS how much you purchased the property for, how much you sell the property for, and whether or not this exclusion of gain from the sale of principal residence applies. And therefore, they get this information on this 8288B, and they look at it, and they wait, and they wait, and they wait. And usually, if the instructions say generally you get word from the IRS that before 90 days, but in my experience, it usually is longer. So we usually have to call them, come on, get to this. And they look at it and say, okay, we agree that, let's just say there's no tax to be paid by this taxpayer. So then they send a copy back to the settlement agent, and the settlement agent says, we finally got this letter, we've been holding the 10% withholding, now we get the approval, and now we can give the withholding tax back to the taxpayer. Usually that takes 90 to 120 days, but the whole process of the 8288B can be started at the point you get a contract for the sale of your property. Soon as you get a contract for the sale of your property, make sure that you either contact the Wolf Group to help you with this 8288B or try to do it yourself, because you want to try to start this process as soon as you can once you have a contract, because it takes some time. So what do? Generally, I would say that if you sell your property any time, let's say before September, you should try to get your money back using the 8288B. If you sell in September, but definitely October, November, December, you might as well just wait for the tax forms to come out and get your refund that way, by using just the normal tax return method and filing a tax return for that year. Okay, so the only important issues, because I do have to leave it exactly at 12:45, and I do want to open up for questions. This is the Foreign Account Tax Compliance Act, FATCA. Many of you have heard and probably experienced, if you have any type of foreign financial accounts abroad, many of you have been told by your foreign financial institution, the bank, a brokerage firm, whatever, that, hey, we have to report all U.S. people, and because you have a U.S. address or U.S. phone number, you look like a U.S. person, and so we don't want to deal with you. The reason that foreign financial institutions don't want to deal with U.S. people or even persons who look like U.S. people on paper is that they're required to review the person's file, find out what the highest account balance that purported U.S. person has in the account, report that and any interest, dividends, and capital gains either to their government, who reports it to the IRS, or directly from that foreign financial institution directly to the IRS. And many foreign financial institutions say, we don't want to do that, so we would rather just have no U.S. clients. And there's a rule that the Internal Revenue Service and the law has imposed that says, in order to figure out if a person is a U.S. person, you look to see whether they have a U.S. passport, whether they have a U.S. address, or a U.S. phone number. And many foreign financial institutions don't care, and they don't want to sit through a G4 seminar to find out that you're all G4's non-residents. They simply think that you're a resident of the U.S., and that's why many foreign financial institutions have said, no, we don't want people who even look like U.S. people. It's not in the law, it's simply a policy that foreign financial institution has decided that they don't want any U.S. people or people who look like U.S. people. All right, you shouldn't be stressed out because the Internal Revenue Service is not a well, they're a little bit like a no, they're not a monster. They're not a monster. As a matter of fact, there's so much budget cuts these days that most of the time, if you get you'll get tax notices. There won't actually be a person behind the form that you get from the Internal Revenue Service, the tax notice. It'll simply be a computer-generated notice. Now, that's good and bad, but typically computer-generated notices have the hardest time understanding handwriting. So you might write to them back, and then you may be caught up in a situation where the computer can't figure it out, or the person typing your information in can't figure it out. But they're not that bad, and you shouldn't be stressed out, because there's usually processes to go through if you've ever been contacted by the IRS that you can usually, most of the time, may be able to get out of any penalties that may be assessed. So let me just say before I open it up for questions again, the Wolf Group has been handling international organization employees' tax returns, and we do tax consulting. We're a CPA firm, we're an accounting firm, and we've been doing this now for over 30 years. And I would say that this is the end of February, and I believe that new clients, we only have a few days left for new clients to take on new clients, because this time of the year, of course, it becomes very hectic. And that's why I have to leave at exactly 12:45, because I'm the tax director at the Wolf Group, and what will they do without me? So with that, I'll open it up for questions again. I'm sorry in advance, I'm not going to be able to...